saving for a future event like a new car or retirement, your savings can benefit from pound cost averaging, such as making contributions on a monthly or quarterly basis, for example, by direct debit, and compounding interest, where interest is earned not only on the original sum, but also the accumulated interest from previous periods. Over time, these two forces work together inside a diversified portfolio of equities, gilts, corporate bonds and cash, and alternatives such as commodities or private equity. The aim is to maximize return for a given level of risk. Your emergency provisions, short, medium and long-term financial goals should be tailored to your own personal circumstances, reflecting your essential expenditure and factors such as dependence, foreseeable expenses such as home repairs, and the time scale of each goal. Key considerations to focus on when planning your investments include how long the money will be invested, your ability to ride out market corrections, your investment experience, the flexibility, track record and charges of each product provider. Charges include platform charges, provider charges and advisor charges. The financial strength of those providers, and how to spread your money across regions, sectors and asset types. Fixed interest holdings, such as gilts, corporate bonds of different maturities, provide stability, while equities, shares in the companies, offer growth potential. Established firms often pay dividends which investors can purchase more units with or use as a future income stream. An active fund manager's work includes analysing the current share price using measures such as dividend yield, price-earnings ratio, net asset value and dividend cover, which is an indicator that dividends are likely to continue. And released market prices reflect what investors believe a share is worth at any moment. Each of these sectors will be discussed in depth in a separate communication. Portfolios may blend actively managed funds with passive index tracker funds to match a given risk profile, and small mid-cap companies used to provide higher growth potential but with greater volatility than large cap firms. The diversification and correlation can help protect and grow your wealth through tax-efficient ISAs and pensions. Why diversification and correlation matter. Picking the right account is only the start. Spreading your money across industries, regions and asset classes that do not all rise and fall together can smooth the journey and keep you on track towards your goals. That is the objective of the fund manager, to match your objectives. Suppose you buy a 10-year gilt, which in academic and financial models is often referred to as risk-free. You are purchasing a UK government bond which provides a stable return within the overall portfolio of the term of the investment. You are effectively lending money to the government. In return, you receive a regular interest and, after 10 years, receive your capital back. Gilts are viewed as low risk because the UK government enjoys a strong credit rating, and the bonds are easy to sell if you need to access the funds sooner. If you prefer lower risk, your advisor may choose more fixed interest investments, such as gilts and corporate bonds. These are generally steadier than equities, which represent company ownership and can rise and fall more sharply in value. Correlation measures how investments move relative to one another. Some move together, such as banks and lending institutions, whereas others move in opposite directions, such as transport companies and oil firms, if prices rise. Imagine owning shares in both an umbrella manufacturer and a sunscreen company, or gas-guzzling lorry and a petrol station. On rainy days, umbrellas sell well, whilst sunscreen sales dip. In sunshine, the reverse happens. This negative correlation helps balance gains and losses across your portfolio. True diversification means holding investments across multiple industries, asset classes, and regions. Owning several companies in the same sector is not enough. Spreading the risk widely reduces the chance of your whole portfolio falling at once. Smart investing isn't about chasing the latest hot stock. It's about blending investments that complement one another to see how diversification and correlation could strengthen your portfolio. Book a call with us today.